Great. I think we have leveled out our participants today. Uh, Thank you, everyone, for joining us today. We are very glad to have you here for our webinar on Friends and Family Funding for University Startups. I'm Kirsten Leute of Osage University Partners, and I'll be your moderator today. For today's webinar, we will discuss the do's and don'ts of raising this special, often first round of funding. For startups at their earliest stages, friends and family is one of the most common forms of startup funding out there. This can sometimes be the best chance to secure money to launch your startup. But what does it really mean to accept capital from friends and family for your startup? How does it impact your cap table? And what are the implications for later rounds raised from VCs and other institutional investors? The panel of experts we have today will discuss valuation and structuring problems and preparing for a raise and fundraising tips. I'm really thrilled to be joined by an array of panelists who have extensive experience in both raising capital from friends and family and assisting startups that have raised such a round from both a legal and financial perspective. I'll have each of them introduce themselves and tell us a bit about their backgrounds. We did want to let you know that one of our panelists was unfortunately called into emergency surgery. He's going to try to join us, but it may happen in the middle of the webinar, and I'll have him, this is Ari that I'm speaking about, I'll have him introduce himself when he's able to join. So we're going to start off with Ian. Could you introduce yourself and tell us a little bit about your background?
Great. Hi, everyone. And thanks to you, Kirsten and Osage for hosting this event. My name is Ian Polonsky. I'm an attorney at Royer Cooper Cohen Braunfeld. We're a mid-tier law firm focusing on the entire life cycle of a business. I specialize in corporate and transactions, starting out from formation of a company through fundraising, strategic commercial arrangements, and exit. I tend to work with companies that have intellectual property or data as the core assets of the company. So a lot of them come from the university spin-out space in similar situations. Thanks again for coming, and I'm happy to be here.
Absolutely. So happy to have you here, Ian. Jerry, can you introduce yourself?
Sure. Hi, I'm Jerry Collins, partner at Century Consulting. Century is a consulting firm that really helps companies out in different phases. I lead up the valuation group. We also help out with the financial reporting, SEC compliance, risk advisory, and outsourced CFO, among other things. So a variety of ways we can assist. Also, I have been in the valuation space for about 20 years, and really through that whole time, really been in the tech and life sciences space, helping those companies, especially early stage companies.
Terrific. Thank you so much, Jerry. So glad to have you here. Tom.
Great. Thanks, Kirsten. Yeah, my name is Thomas Kim. I'm the president and CEO of Epivario. Epivario is a spinout from the University of Pennsylvania, co-founded by Dr. Shelley Berger and Philip Muse. And we're applying epigenetics in the neural space to treat memory-related psychiatric disorders like PTSD and drug addiction.
Great. Tom, thank you so much for being here today. And as I mentioned, Ari can hopefully join us later. We'll see if he can, and he can give us an introduction for himself then. I just want to note that our entire panel here is Philly-based or around Philly-based, which we're super excited about. I'm not sure we've done that before. So really glad to have all of you here from the Philly area. All right, so today's webinar is being recorded. We will have this up on our YouTube channel, as well as our OUP Partner Portal, which is for our university tech transfer partners. We have it noted here where you can find this afterwards. And then the other thing I wanted to mention before we jump into things too is that we do encourage people to ask questions throughout the webinar. You can find a Q&A feature down on your toolbar, and please ask questions throughout the webinar, and I'll be monitoring those and then asking them of the panelists as appropriate throughout the webinar. So please do ask your questions. And for today's discussion, Ian and Jerry are going to present a few slides and provide a legal and financial perspective on the following topics. What does it mean to accept capital from friends and family? How does it impact your cap table? And what are the implications for later rounds raised from VCs and other institutional investors? Afterwards, we're going to hear from Tom and hopefully Ari on their unique experiences in raising a friends and family round for their companies. And then we'll launch into the Q&A period involving all of the panelists. So Jerry and Ian, why don't you start us off on structuring a friends and family round from a financial and legal standpoint?
Sure, thanks, Kristen. I just wanted to say, it looks like Ari may have joined, so maybe he wants
Oh,
to...
great. I'm sorry, I missed that. Ari, I'm
Hey
so
guys,
glad you could make it.
I know it's I'm in a tiny little closet between two operating rooms, so it worked out well.
Well, terrific. We were actually just about to launch into things, but please, if you could introduce yourself first before we do that.
Sure. My name's Ari West. I'm a plastic surgery resident at the University of Pennsylvania, co-founder and chief technology officer of a medical device startup spun out of Penn and Chop called Osteo, where we're making basically a new type of pediatric craniofacial hardware fixation. I think I'll just leave it at that and let us get started here.
Great. Well, we were so glad that you were able to join us, especially squeezing yourself in both physically right now, as well as in between, obviously, some other heavy obligations that you have. And just to let everyone know, so Ari rounds out our Philly panel here, everyone being based in the Philly area. So we're glad to have you here. All right, Ian, go ahead.
Great. If we can go to the next slide. So just a quick overview of a few things we wanted to cover at the top, just to make sure everyone's on the same page, is some kind of key issues around friends and family rounds. So we'll start with, the obvious, what is a friends and family round? We'll talk a little bit about who makes up friends and family. It involves friends and family, spoiler alert. Next, we'll cover what is the right instrument to raise a friends and family round. There's different mechanisms and legal structures and ways in which you can bring money into a company. And then what do you need to do before you raise money? Some kind of internal housekeeping and other things that are important to have in mind before you go out hat in hand. So next slide. So first, what is a friends and family round? Friends and family round is typically considered that first money that comes into a business. As I say here, it's often between $10,000 to $250,000. But the range is so large and not exclusively so, because it really depends on what the company is looking for and what it needs. Some companies just need almost nothing these days, right? You just might need a few $1,000s to get a web server going, and you work on the coding, and you're up and running with a prototype. Others need to conduct, lots of trials and tests and anything in between. So really, you have to think through, as your business, what do you need to get it going? And in terms of what a friends and family round is, as opposed to other times in the life cycle that you can raise money, you may have heard the phrase angel round. An angel is typically a serial investor who puts money into lots of different companies, that comes in with a little bit more money and often looking to have a bit more of a say in what goes on with the company. They have experience, they want to be involved. You sometimes see what's called a series seed, which is kind of a slightly larger raise, and sometimes the beginning of you taking in institutional money. So you might have private equity or venture-backed companies giving you money, but still relatively small amounts as compared to what you see in the news from Silicon Valley companies that are raising 10, 20, $100 million. And then, of course, you get your series of letters, which, depending on what are the key milestones of the company, you may need more and more money before there's an opportunity for an exit. Jerry, anything you want to add?
No, not on this.
Okay. So next slide. So who are friends and family? Except for the obvious, there's a little bit you should still keep in mind. It's not just anyone you know or anyone who you share, you're related to. Oftentimes it's the founders themselves. Sometimes folks bring a little bit of money to the table, kind of to demonstrate that they're invested, not just with their time, but with a little bit of capital to show that they're really going to stick around and believe in whatever the company is going to be doing. Oftentimes founders start with going to their existing personal network, whether that's through social media or people who are the folks that are interested in helping a startup business. And the key when you're thinking about who is the right person between that network of friends and family it's not all about the money, right? Some people might have certain industry expertise. They themselves might be finders, folks who can help introduce you to other people because they just themselves have a great network. Sometimes they'll have yeah, as I said, they could have some kind of expertise that could be helpful to the company. They might have a name that could introduce you to other people. But keep in mind for who you're taking money from to do a little bit of diligence and vet them a bit. And that's what the watching out for unaccredited investors. You haven't heard the term before. An accredited investor is a term of art out of the Securities and Exchange Commission. And it's a protection put in place by the federal agency to make sure that only people who can really afford to lose an early stage investment are able to make certain types of investments. You don't want somebody who only has $10,000 to their name to be giving that money to you, because while everyone thinks that their company is going to be successful, it's a long journey along the way, as Tom and Ari will tell you. And you want to make sure that there are people that are positioned that this isn't the one and only thing that they're able to be putting their money into. Accredited investors also, if you only take money from them, allow you to avoid registering your offering, which is a complicated process that could take up an entire other webinar. But the short answer is, it's often, when possible, if you can take money only from accredited investors, it will make your life easier long-term. You'll have less legal regulatory compliance to get through. And you'll also have an investor group that is likely better positioned to help you both in the short and the long term. So it's a good rule of thumb when you can to stick with accredited investors. Jerry, do you? Next slide.
Sure. And I guess the other part there too, one of the things I think has come up more as in now than in the past with the ease in which you find out information about people, as you sign on investors. It's also not a bad idea to see if there's any bad press, anything out there that is negative. I've seen that trip up some companies in the past where there's a maybe either an unsavory person or some news out there that at least you should be aware of. So another little piece there as you think about your investors.
And we do have a question from the audience about how do you know if someone is accredited?
Yeah, that's a great question. It's a set term. You can go, actually the rules changed recently, so there's new criteria of who applies, but it has to do with their income level or their overall net worth or their experience in investing. And then there's a few more technical categories as well. The short answer is when you're raising money, you should have folks fill out what's called an accredited investor questionnaire, where it asks them all of these questions. And they will be certifying to you by signing the document to say, yes, in fact, that's true. But if you're not sure if someone's just filling out the form and not thinking through it, you can ask for things like, redacted tax returns, other kinds of proof of their wealth to make sure that they fall into that category. It's obviously a tricky balance. Someone's trying to do you a favor and hand you money, and then you don't want to ask them a million questions. So I would say, use your judgment and find people that you trust, because if you trust them, they're likely not going to be lying to you when you ask them a direct question.
And a related question then was, how difficult is it for someone to become an accredited investor? And it sounds like from what you said, there are multiple ways you can, but difficulty, yeah. I mean, one is just having money. But
it's mostly, for lack of a better word, you need to have money to make money or to spend money. So there's not much you can do unless you've gone through like unless you have like a financing background, and then there's some exceptions there. So yeah, it's not like you can take a test and now you're accredited. It is really tied to your wealth, and the reason being, from a policy standpoint, as I said before, you want to make sure that the people are not risking their lives or their livelihoods for your company. This should be part of a diversified investment portfolio for them.
Great, thanks. That was all the questions we have so far.
Let's get to the next slide. So what is the right instrument to raise a friends and family round? So the first one up here are grants and gifts. Grants, I see that personally, I see that a little more in the life sciences space, but a grant is essentially a gift from usually an organization, government, that you don't have to pay back, and gifts from individuals. I think if you think about it, this is going to be the great way to get money, right? You don't have to pay it back. It doesn't hit your cap table. All wonderful. I think then really the challenge here is not a lot of people are just giving away money. So I think that's it's going to be a little bit harder to raise enough. Some of the grants, especially as I've seen in life sciences companies, can be substantial, and then could get you along the way a little bit. But generally speaking, definitely a good way to get money if you can. Then you move into the loans, and we have simple promissory notes and convertible notes. Simple promissory notes are like any kind of a loan that you would go out and receive. Car loan, you're going to borrow, either give or borrow a certain amount of money, pay it back at a certain rate over a certain period of time. Convertible notes, and historically, a lot of early stage companies I see fund this way is a note for a set amount, but it has the additional option of being able to convert into an equity class, shares, stock. So it's nice from the perspective of both parties in that it doesn't necessarily hit your balance sheet from like a loan perspective. If you want to, you can convert it out. So it's not going to be out there until you pay it back. It's not going to be necessarily a hit to cash flow. And it can convert back into equity. There's also a little bit more upside for the individual that takes this route. So a nice way to think about ways to get money for an early stage company. The next one is relatively recent. I mean, they've been out there since 2013, but safe notes, simple agreements for future equity. And unique an instrument that's kind of starting to really take hold. I think over the last couple of years, I've seen more of these. It is essentially a opportunity to partake into a future round, and they aren't debt. So they're just really a future type of agreement on a round not yet out there. And then the last type is equity, and it's really you're giving away part of your company. And that is beneficial in that you don't have really the hit to cash flow and anything on your balance sheets, but you're adding business partners, as they say. So
yeah, and I would just add to that. Oftentimes for this early round, you're in if you're lucky enough to get a grant or gift, great, but you're often in the loan or safe space, mostly because it's hard to know exactly what the company is worth and how much people are willing to give you for a piece of the company when it's that early. We'll talk a little bit more about valuation, but it's really challenging because it's so early and you don't necessarily know how much it's going to cost to get the company up and running, how profitable it's going to be, all those things. And the benefit to your investor of using either a convertible note or a safe is that you're typically giving them a discount on whatever that future round is. So if a year later you raise money in equity at say $1 a share, in the convertible note or the safe, you might say, well, I'm going to give you a discount of 20 or 30% on whatever amount you raise in the future. So that means that the buying power of the money that they put in, rather than it costing them $1 per share, it'll only cost them 70 or 80 cents a share. So they end up with more of the company in that future equity round than they would get if they just did straight equity early on when no one really knows what's the right price.
Okay. Next slide, please. So what do I need to prepare for a raise? One of the things that's always beneficial to consider or think about getting is a valuation. Typically, you're going to get a 409A type of valuation. That's really a tax and to a certain degree, a financial reporting type valuation. It's going to be important from a tax perspective. It also sets a value for the company if there are more than one round of shares, or if there's no arm's length types of transaction, which means there's no independent people kind of coming into that round. So friends and family, typically you're going to have a relationship with all those individuals. So there is not that distance that would be considered fair market value. So a couple reasons why evaluation is important to get at that time. Prepare your cap table. I don't know how many times I've been involved with companies that are early stage, and they actually don't know what, how much equity they've given out, or it's an absolute Herculean task to kind of put that together. So a cap table prep, whether you kind of go and prepare it yourself in an Excel document, or there's a variety of different cap table management softwares out there that can assist in that. But it'll save you a lot of time and effort, especially as you kind of move through your funding rounds. It is surprising how often this trips us up when we're trying to do evaluation, or when you get to the point where you're getting audits done from, getting your financial statements prepared, and this can really delay that endeavor. Corporate governance, again, it's important to think about your board. They provide a lot of benefits. There's checks and balances. They support management. You can add talent, people that have expertise in areas that you may not be particularly an expert in. So an important thing to think about. And I'll go through this, and Ian, I'll shoot it over to you on those last two pieces. And then, invention assignments. If you're having some kind of intellectual property created, you need to have that in place so there's so that stays with the company and that doesn't leave with if someone were to walk out the door. And confidentiality agreements, NDAs, I think are very important, and I'm sure Ian will talk about that as well. But you always want to have non-disclosure and confidentiality agreements signed, so information doesn't kind of leave.
Thanks, Jerry. And completely agree with everything you just said. And also on the corporate governance side, sometimes when a company is this early, you may not even have formed a company yet, and you need to think through, should we do an LLC? Should I do a C Corp? So you want to actually make sure you have an entity before you go out to raise money, so that people have a place to put the money into. They're not going to just write you a personal check. So you should be working with a legal and tax advisor to figure out what's the right structure for your company. And a lot of that might be determined by what type of business it is, where you're going to be looking for investors in the future, and what, if any, tax benefits there are in one form or the other based on the type of business line. And then in terms of invention assignments and confidentiality agreements, as Jerry said, it's really important to have all that stuff locked down early stage, particularly if there's a technology in play. As a founder of a company, if you're not an employee, you actually don't, just by virtue of working on the project for the company, have given your rights to the company. So you need to actually sign a document that does that. And if you don't do that, and you say have 3 or 4 co-founders, and then one of them moves on to do something else, and you never got any documents in place, and then 3 years later, you're looking to raise a serious amount of money, and your investor says, well, where's the invention assignment from that co-founder that came up with the idea? You're going to then have to go back to that person, and that person may not be as friendly as they were when you started working on the project, and might, at worst, they might just not sign anything, and your company is kind of stalled out. And then a better situation is they just rake you over the coals for more money than they probably deserve, but you kind of have no choice to give them more of the company than you should. And it's a simple form document, but it's crucial to take care of some of those things as early as possible, because they're the kinds of problems that can be catastrophic down the road.
We do have one question on this particular topic on corporate governance. Because friends and family dollars come in so early, is there a risk of having too much corporate governance already in place at this early stage?
Yeah, that's a great question. A lot of it will, and you're going to hear this because I'm a lawyer, it always depends. But if you have a company that is just one founder, and has no one else that has any voting rights or anything like that, then you don't need much in the way of that. It's just one person, single member LLC or what have you, easy. If you have a bunch of co-founders though, you might want to have some documents in place. It doesn't have to be a lengthy document, but at least sets out some core principles as to what happens if somebody leaves, or how long do people have to stick around in order to get their interest in the company. Because if I'm an investor, I want to make sure that the company has thought through what's in the best interest of the company and not just the individuals who started it, so that my money is going to be well spent, not on sorting through a dispute when interests are no longer aligned, but having it set up for all the money that goes in goes towards developing a product, marketing, et cetera. It's the kind of thing that you work with someone to figure out what's the best way to allocate your resources, just like anything else, right? Like legal and accounting are really important, but you can't spend all of your money on a perfectly set up company that then has nothing to do. So you often talk through with your advisors and pick your spots and take care of the key things that you need right away, and then build on that as money comes in and you have the opportunity to do it. You'll find that's the case on almost all aspects of a startup business, but there are some things that are more important than others on the corporate side. Some of them are like having an entity set up, owning the IP, the invention assignment piece, and maybe a couple of key points as to what happens if somebody leaves the company. And that alone will get you pretty far with an early stage startup.
Great. Thanks. Let's keep going, because I know we're anxious also to get to Tom and Ari's stories. So. Oh, and here we are. Terrific. Great. We're actually going to stop the slide share right now, so that we can see everyone at once, hopefully. And Tom, we'll start off with you and your story of your current company and the raising of a friends and family round that you've done.
Sure, thanks. Yeah, trying to recollect, and I joined the company in March of 18, and through the Upstart program at PCI, was introduced to the co-founder. So, as we were trying to plan and strategize for the company, it was an LLC at the time, created through Penn Ventures. And then the thought was, if we could bring in some seed capital to kickstart some of the studies and build off of what was done in the lab. So in the beginning, we were thinking somewhere along the lines of 150 to 250,000. And I'm an attorney as well, so I've worked with outside counsel at my former, which is KHA over at Dwayne Morris. So little pieces I knew were already there, and so ultimately it came down to, how do you build those pieces? If you needed 150 or 250, you start kind of building circles, your circle, and then those circles bring in other circles. And we ultimately ended up raising 450,000 in that first round. So I think you have to have some level of expectation in terms of whether it's your own personal circle or the networks that you have, in terms of, I think Ian was talking about consultants or advisors or mentors that you've worked with, and if you can tap into those circles. And I think we talked about this before too, is you never know when one of those friends and family commits, who some of them can be like Pied Pipers and bring in networks of their own friends or business associates that like to invest together. So that happens too. I don't know. That's a little bit of the beginning.
Yeah, that's helpful. How many people? So how many different investors did you end up having for your friends and family round?
So that initial 450 was probably like 15 people, a little under 20, and then we've subsequently had to go back and open up that offering to bring in some bridge funds. So in total, and we did that, I think 4 different times. So in total, we've raised 717,000. And probably now it's probably like 20, 25 people, 30 people, in that range.
That's great. All right. Well, I'm sure we're going to actually hear more bits of the story later, but I definitely want to also hear Ari and your experience with Friends and Family Round.
Yeah, sure. Thanks, Kristen. So we started the company, Osteo. We spun it out about 3 years ago. And like most spin outs, we existed on non-dilutive grant funding that we were able to scrape together around Penn and Wharton and CHOP, the Philadelphia Pediatric Device Consortium. And I think is a common story. The first grant we got was $1,000. The next one was $3,000, and then 25, and then 50, and then 50. And then it really became clear that there was an inflection point where we had our kind of benchtop proof of concept prototype, but to take it to the next level and in medical devices, that's really kind of moving into a quality management system and working, either bringing engineers in-house or working with a firm that does work within a quality system. That was going to be a large kind of cost inflection point for us. So that was when we decided to kind of change gears and raise a Friends and Family Round. Obviously, even until today, we still are pushing on the non-dilutive grant funding with SBIR applications and things like that, because one of the things that we've been really I guess it's intuitive in retrospect, but potential investors love to invest in things where there's also non-dilutive money coming in or potentially non-dilutive money on the horizon. It's a multiplying factor for their investment that doesn't dilute them. So about 16 months ago now, we decided to raise a Friends and Family Round. And the term is probably used loosely in our case. CHOP put in about half of the round. The round ended up being sized at about $520,000. So CHOP put in about half of that, and then about 8 angel investors, which really fit the typical definition of friends and family, filled out the rest of the round. So those investments ranged from $5,000 to $50,000. We raised a standard equity round, so we were able to agree on a valuation with CHOP, who really led the round, and everyone that followed was okay with the valuation that we set. So we raised that round, and that really kind of slingshotted us. We were able to take our development efforts in-house with a firm that does medical device, quality engineering. And that momentum led to us bringing on a full-time CEO who's kind of from industry with a background at DePuy Synthes, which is super relevant to kind of the space we're in. And yeah, so that cash has lasted us. We have a little bit more runway, so it'll probably be about 18 months between our Friends and Family Round and our, which we're really kind of calling our pre-seed round, and the next round we raise, which will be our seed round, where we're looking to more kind of traditional investors. Although that being said, a lot of the investors from the first round have said, they're interested in partaking if we find a kind of traditional investor who leads the round with formal diligence and things like that. I think I'll leave it at that. I know there's going to be a lot of questions.
I've already got a follow-up question actually for both you and Tom. And we'll start with you, Ari. But I'd love to hear from both of you on this about the approach of making the approach when you're raising a Friends and Family Round. Who did you go to approach, and did you ever have to decline? And when? So Ari, I'll start with you here, and then move.
Yeah, great question. I think so much of this, so much of entrepreneurship, and so much of fundraising in general is really being able to tell a story that you've come to believe in fully, and in raising a Friends and Family Round, that couldn't be more true. These are people who you have relationships with. Obviously being totally transparent and honest is of the utmost importance. And so the kind of narrative that we were telling was, we didn't really approach anyone asking for investment. We really just approached friends and family that most of whom work in finance or have made small investments in other startups before, or in our case, physicians, because we knew that they would be able to kind of vet the technology in a way that other people, non-physicians, couldn't vet the technology. And we really just kind of presented the opportunity and what we were, what we saw the future looking like, and what the particulars were going to be. And once CHOP was involved, that obviously lent a lot of credence to what we were doing. So it really wasn't us, calling up friends and family, asking for their time, and asking them to invest. It was kind of almost the inverse, where once people started hearing that we were raising money, they were excited by the idea. In our case, the technology that we're trying to replace, it's very niche, but it's a type of fixation device called a distractor. And the way it works is it pokes through the patient, which is usually a toddler. It pokes through their skin for about 3 months. The parents turn that device by hand. So our technology works very differently than that. It doesn't protrude through the patient's skin. And the reason I bring that up is because, just that kind of simple narrative did a lot to really kind of foster interest in a number of friends and family of ours. The second part of the question, did we have to turn anyone down? We did have to turn 2 or 3 people down because they didn't meet the criteria on the accredited investor survey. And while at the time it felt like kind of a technicality, I will say the second you're done fundraising a friends and family round, it's not like all the stress and everything is gone. It's a new type of stress, certainly. I see Tom chuckling, and he can surely speak to this. But the stress of having your friends and family's money on the line was certainly new for me, and I was really happy that our lawyer, really underscored the importance of the accredited investor survey, because I can't imagine what that would feel like if it really were, someone who probably couldn't have or wasn't as smart of a financial decision to make a high risk investment like, one in a startup. So there were about 2 or 3 people who we had to turn away, and actually some of those people kind of collabed with one another through an accredited investor that also wanted to invest, and so yeah, that was the only situation in which we turned people away though.
That's really helpful to hear. Tom, what was your experience of the approaches, and did you have to
Yeah.
define?
Well, I'll answer the last question first because that was easy. I mean, it's similar, really turning down only folks that didn't meet the criteria of the accredited investor. And then, the approach, and I would say the approach is really, like Ari said, being honest, being transparent. I'm doing this because I'm passionate about the technology. I want to help build this company and, bring much needed pharmacotherapies for these major neuropsych disorders like PTSD and drug and alcohol addiction. So I think you have to go that way. And then the other thing, and we've talked about this before, where it's you gotta make sure you change your mindset where you're not asking for money, you're really providing an opportunity. So I think there's that mental switch where it's like, I'm providing you an opportunity. And the way I've always approached it is, if it fits within your investment profile or your investment strategy, and if you have that opportunity to add a high risk investment, then this might be right for you. Because the area that I've always been surprised in terms of the network, I had a couple of friends who were very high net worth. I had one friend who, day traded about a $10 million account. So, you think that guy's pretty, he's got a lot of disposable income and he's investing high risk already. But it doesn't, if they haven't invested in early stage, biotech for me, therapeutics, people who've been successful, they're just going to keep doing what they've done before to be successful with their money. So you start learning that just because they have a lot of disposable income doesn't mean this is the right investment fit for them. So it doesn't mean don't try, pitch that opportunity. But again, it's opportunity. It's not asking for money.
That's great. Great advice, Tom. So we have a number of questions from the audience, and I'm going to start going through those. Plus, I still have other questions I know we pre-prepared for this. So one of the questions was, and Jerry, I'm going to direct this to you first, and then maybe the rest of you can chime in if it's of interest. But please comment on the trade-off between number of friends and family investors and the check size. It might be easier to get, $50,000, $10,000 checks versus $10,000, $50,000 checks, but do you want to manage 50 investors, basically? Can you talk a little bit about that, and perhaps also what that means for your cap table and future rounds?
Sure. So my experience, and again, this is from helping out clients, not necessarily dealing with them, is that the less people that you have to deal with, the better. From an investment perspective, it's easier to kind of get a consensus. It's a lot, the other part of it too, right? You have a dissident or an unhappy shareholder, right? The more opportunity you do that with larger amounts of people, that increases your chances. So that's an area where I think the lower the number, the better off you are. It's also easier to maintain a cap table. I have seen companies lose individuals because they have a large cap table with a large amount of investors. And that coming back to significantly hurt them in coming back around to it, especially when they were looking to do a deal or potentially go to the public markets. So I would say that if you can, it's better to take larger amounts of money from fewer people than smaller amounts of money from a lot. At least my perspective.
Yeah,
I would definitely agree with that. I will say there are, to the extent that you don't have that trade-off and you're just stuck with, I need to find 10K from 50 people because that's who my network is. There are tools that are available now that help with cap table management. So it's a little bit easier than it was even a few years ago. Carta and Cap.io are kind of two of the more well-known. So you can outsource some of the difficulty of just having the list of people. But keep in mind, if you're having more people, you also have what's called blue sky filings, where you have to keep track of what states people are located in, their residence, and make certain state-specific filings in order to keep your, without boring everyone, like certain exemptions from the securities law require that you might have to make a simple filing, but a filing that if you don't make it and things go bad with your company, it's an easy excuse for one of your investors to come back and gut whatever is left of the company for themselves. It becomes an administrative burden in a bunch of ways, and something that you have to then reach out to your attorney every time to make sure, oh, well, now I have 10 people in this state and 7 in this state. What do I need to do on filings? So the more people you have, it's just more that you need to manage. That takes away from the running of the business.
Yeah, my take would be, I totally agree. But obviously you got to work with what you got. So what we did was we had the first probably 5 or 10 conversations to try to tease out what that average investment size was going to look like. And then we made an arbitrary decision because we felt confident that we could raise the amount we needed by setting a minimum investment size of $25,000. And I had previously mentioned that the range of investment sizes for us was 5 to 50, and 1 or 2 people really wanted to take part, and they were friends and family and people who we thought may be able to add some value, and we wanted to be involved. So we made exceptions in those cases. But definitely we did some kind of data gathering before we arbitrarily set that cutoff. But I totally agree with the underlying sentiment. It's just fewer moving parts is simpler.
Yeah, I mean, I agree with all that. The only thing I can add is with the smaller check size, I mean, I guess even with a larger check size, if there's a lot of red flags as you're discussing the opportunity, and it's kind of like you're dating and you notice there could be issues, then you should definitely take that into account.
Absolutely. Yeah. I'm going to go with a question to you first, Ari, and then I've got some other questions to pop to the rest of you. A question from the audience was, how did you attract a CEO of the caliber you mentioned with the amount raised at that time?
Yeah, networking, only networking. I see a lot of physicians spinning companies out, and they are pretty much fully reliant on the university to find them, leadership for their company. And that certainly has worked for people in the past, but I don't think, I don't think you're best served by assuming that they're going to sort that out for you. So in my case, it was just the craziest chance. This contact I had from a few years before, who's in med devices, I saw some success he had on LinkedIn, and I pinged him and said we should catch up. We happened to catch up, and he happened to have just been introduced to someone who was looking for a startup opportunity. So, and that was at the time something that was kind of out of character for me to do. And in retrospect, you can't imagine what it would have been like if you hadn't done it. And so, and it's just all networking. So as you start to kind of build that network, people will know about other people who are, working for a big company, looking to kind of play maybe a C-suite level role when they haven't had C-suite roles in the past, but they've played leadership roles in big companies. And it's tough when you're in academics and in an academic institution. It's tough to build that network, but it's really critical.
Yeah, definitely. Couldn't agree more. So there's actually a couple of questions about, the equity provisions, et cetera. So I think I'm going to initially address these to you, Ian, but then others can chime in too. So one was about, shouldn't founders impose vesting provisions on themselves to prove that they're serious to investors and to each other? So vesting of their equity, I believe it's the question.
Yes, it's one of those things where if you don't impose it, I think for friends and family around, you probably don't need it, because a lot of those people trust you as a person, either through directly or through one step removed. And so they're not going to necessarily grill you on, well, where's my money going, in the same way that they will at maybe an angel level or further down the line. Some investors will require that you have one in place, and they may not care what you put in place. They have their own way of doing business and how much they want. You might have run the company for a year, but they come in and they say, well, we'd like to start, and a normal clock is anywhere from 2 to 4 years. And they might want to start the clock when their money comes in. And then it's just negotiated, how much you get credit for what occurred before and what not. I would say it goes back to if you have co-founders, I would recommend that you put something in place for everyone, because especially if it's more than 2 people, because it's inevitable if you have a team of 3 or 4 that one of them is going to, for whatever reason, not be involved in the company a year after it starts. Just things come up, life changes, not even necessarily a bad thing, just different opportunities, different life needs. So putting founder restrictions in place makes a lot of sense. The one thing I would say if you do that is to make sure that you do the appropriate tax filings to lock in the value of that equity at the time that you put those restrictions in place. Just trust me on that, because when the company's worth nothing, then there's nothing to pay tax on. But if you have it vest over time and then you get that equity 3 years later when the company's worth a lot of money, if you didn't fill out a 1-page piece of paper, you might have a very large and unexpected tax bill when no one is yet handing you money for the company. So again, these are the very easy to fix but important not to miss things, which is why, not just as PSA for why lawyers and accountants are helpful, but it is important to start talking to those folks even high level early on so that you don't make those mistakes.
Right. Sometimes you just don't know what you don't know.
That's right.
Right. So we have another question that's a little bit farther afield from friends and family, but I think it's an interesting one. And it's that this person joined a startup as a CEO and has been working without a salary. Are there guidelines for the equity participation to expect in that kind of situation? And I don't know if you guys have any comments on this. I know that we have a founders equity deck that we're happy to send out to anyone who reaches out to us. But it is something that we get a lot of questions on, like how should founders equity work? How should it be, divided up with the initial CEO, et cetera? And love to hear any comments that people have on that.
So, I mean, I'm happy to
Go ahead.
Well, yeah.
Or no, but Tom, you can go first, please.
Yeah.
No, I was just going to say, I mean, I don't have enough iterations to say what particular number. I just, I know through talking with, former colleagues and mentors, you want to get somewhere to the point, and I'm talking from the CEO level, where, you do that big Series A, B, you get diluted down, and you're still in that maybe high single digit percentage.
Mm-hmm.
Yeah, I think that's right. And I think what you should do when you're starting the company, try and map out for you and your co-founders, if there are, how much equity do you want to have at what stage of the company, and do some math where you figure out, well, if we all start out, there's 4 of us and we're all even at 25%, and we have to give away 30% of the company over the next few, early investment rounds, well, then we're all now diluted down collectively to 70%. And we still need 3 of us to agree on something to get to a majority. So that's pretty good. Once you go past that, you bring in more service providers and things of that sort, you keep getting diluted down. And if your company's doing well, you will inevitably get below majority control sooner than later. But when do you want that to be, and how important is control of the company for you versus just bringing in smart, excellent people and raising the money and then handing it over to the larger organization and getting an exit? Your answer to those questions will certainly change over time, but it's good before you go out for that first money, at least to have a vision, because it's a question investors will probably ask you. And it's good for you to have in mind on how you envision the life cycle of the business itself and your involvement in it.
Great, thanks. Another question that we had come in was crowdfunding sites like WeFunder start with a friends and family round and help streamline this process prior to moving to public fundraising. I'm not as familiar with this. Are you folks familiar with this? And if so, what's your general feeling about this mechanism, crowdfunding? We have no.
I don't mean to dominate, but all crowdfunding is not created equal. I think you heard from both Ari and Tom on the importance of accredited investors. There are some crowdfunding sites that vet and make sure that those folks are accredited. And in that case, that could be a great tool. If you don't have the personal network to get to the amounts you're looking for, that is certainly one way to do it. You're then faced with the same kind of concerns people already raised, where like, well, how small of an increments am I taking? If I don't really know these people, how much, what is going to be the back end expectations from them, and how involved do I have to be in talking to them? There's not that trust built up that you have people that you really know. And so your relationships are harder to manage. But as I think Ari said it, right, you got to work with what you got. So if that's the only option and the alternative is no business, then go for it, because otherwise, what are you doing?
So another question that we had was, what questions, when you're going out and raising friends and family, what are the questions you get asked? So I'm going to address this to you, Tom and Ari. What question do you get asked most often by people who may be interested in being an investor as friends or family? Or is it not common? Like, is there not one question you're being asked? Is it very varied based on what people's interest is in investing you?
I think, and Tom, I'll be curious to hear your response. But we are currently raising a seed round, so we're pitching to more traditional investors now, and I don't think the questions are that significantly different between the friends and family round and the seed round. I think there's obviously there's obviously some education that needs to happen around the risk of the investment if it's someone who doesn't normally invest in companies that are that early stage. I think for me, I felt totally obligated that to inform everyone who's investing that they realize, even though I'm super confident in what we're doing, on the spectrum of investment risk, this is maximal risk. And I was happy that I had that conversation with everyone. And so there's a little less of that education that has to happen with traditional investors, obviously, or there's a lot less. But other than that, there was a lot of interest about what timeline to a liquidity event or an acquisition, likelihood and amount of future funding needs. And those are all things that are similar to, questions that institutional investors were going to ask. So I didn't think there was anything that stuck out necessarily.
Mm-hmm. Good to hear.
Yeah, I would say for me, I mean, it's the typical questions in terms of, where you are, the money and, and then where's this going to take you and then the final value inflection milestone. But I'd say on top of that, because of our particular technology, because of epigenetics and this in the neural space, I guess the more common questions for us is memory. That is a big trigger word for people when you mess with memory. That causes a lot of, especially I think Julia Roberts, her Homeland or Homefront, that show came out on Amazon. Homecoming, yeah. So that is it like Homecoming? So that's always a big question. And then I think for us, then the other question we get a lot is the regulatory path, because as Ari probably knows, there's not really any real therapeutic, pharmacotherapeutic to treat PTSD or addiction. So that's a big question. What's that regulatory path look like?
Thanks. Jerry, for those investing in a friends and family round, what do they typically see as the upside for these investors? Is it mainly the potential financial returns? Is it altruistic? When you're seeing this, what is the upside people are potentially looking at?
So, I mean, and again, I get a limited amount of exposure to this from that perspective, but what you see is, I think, really a kind of a variety of different circumstances, right? Had somebody invest in their son's company, right? So they're really looking. They're not necessarily really looking at the upside. Obviously, they don't want to lose their money, but they're not really looking at the upside. It's about helping out that individual. If it's like in the life sciences space, there's people that are more altruistic in the fact that they just believe in an indication, right? Like how that's going to help people from a larger degree. And from what I see a lot is, everybody's thinking about that potential return, right? And that's, something it depending on the level of sophistication within the investor, how much of a return they're looking at. Friends and family, I would say, generally speaking, there's not that expected return that they're looking at. When you get into some of the more PE type individuals, IB type individuals, they got a number in mind, and so they're going to be a little more focused and directed about what that return is going to be. But that's generally a later round. That's not really around the friends and family round.
Great. Any other comments from anyone on that?
Yeah, what I would say is for the folks that invest in Epivarial, there was a group that was, as Jerry mentioned, that you just wanted to trust in you, help you succeed. There were any investments of like 10,000. It's like I know you're gonna do well with it, and I trust you, that kind of thing. Mm-hmm. And I think, as Jerry mentioned this as well, some people are really interested in being part of something new, had some particular affinity for, or ties with, for us, PTSD, or knew somebody who had an addiction. issue, or somebody wants to be a part of a big story. So I would say it's in those buckets.
Okay, great. So we have another question, and I'm going to try to get it right here from the audience. It's basically this person has a demonstrated working prototype in the biotech space. So this is great, Tom, Tom and Ari. And then he says it could be argued that selling an idea prior to revenue makes raising money easier, and he mentions bootstrapping maybe to get to revenue versus raising money to get to revenue. Because it can be limited afterwards when you first actually start getting in revenue. Do you have any thoughts on this? And I'm not quite sure I got the question quite right on this, and you may understand it better than I do.
I'm not sure I do understand. It sounds maybe like it's a question of licensing versus, I mean, when I hear selling an idea, to me, that sounds like licensing, or at least from the academic world, I think about that as licensing. And it's really a question of if you want to take that idea into and build a company around it, or if you want to let someone else do that. And if that is the question, then I think it is just a question of personal preference. You know, there's plenty of people in the academic realm that build careers around licensing technology and make a tremendous amount of money doing it, and they, you know, fashion themselves inventors and don't want to be entrepreneurs. And I think there's nothing wrong with that, but it's just a question of kind of what drives you.
Well, I'll ask the person if the person is still on to maybe clarify, since I don't think I got quite where the question was going to. On that. Jerry, did you have a response as well?
No, I think I would kind of follow that up the same with Ari. I think you see people who like to come up with ideas, and they're not really into the wanting to build a business, right? Build a company, do that entrepreneurial part. They like the excitement of generating an idea. I mean, from a return perspective, generally speaking, if you stay along with the business and create the business, there's probably a little more upside, generally speaking. But yeah, I mean, it's what you're comfortable with, right? And I think that's important. And you see that a lot. We see people who sell the whether it's a prototype, some intellectual property, a molecule, versus somebody who builds a business.
Okay, great. All right, and the person's over there, we actually did answer his question, so that's great. Thank you all. And actually, so this next one, I think that it actually goes into, and Jerry, I think I'm going to direct this initially to you, because this is, I think this is something that sometimes comes up, and so people get a little bit nervous about friends and family sometimes, but it is a common mechanism for companies to start off with. And this person says, should friends and family investment be avoided for companies that will need to raise many rounds in order to get to market? And Jerry, I'm happy to start with you or Tom, but also to go into, you know, what is next, Tom and Ari, for your companies and their rounds.
Yeah, I mean, from my perspective, I've seen companies bypass the friends and family round, right? You know, it depends, I think, in a lot of things, like where their access to capital is, if they even have friends and family that are likely to invest. So, I mean, I think it's a bit of a where you are. You know, I don't think anything fits every company, right? Like sometimes you just don't, you can bypass that. Maybe, you know, and the other part of it too is maybe you already have you were able to get grants and some other access to other funding that, you know, you just need to go to the next round. Maybe you're into angels or some of the more sophisticated investments.
Yeah, in my mind, the relevant, sorry, Tom, you want to go ahead?
No, I was going to agree. And it's just, it depends on your circumstance. And for us, we just needed to be a little more, you know, more efficient than just waiting for stuff to happen in the lab with R1 funding and stuff like that. So that's why we kickstarted that, and it helped shape our story.
Yeah, I totally agree. And I think working backwards from where are the value inflection points going to be, it can be helpful. So if you think you can build a functional prototype and prove out, the big risk areas for your technology for $250,000, then raising $3 million is just going to dilute you unnecessarily. When you could raise just 250, prove that out, and go raise more at a higher valuation. The downside to that is just one of efficiency in that every time you go to raise a new round, it takes energy and focus away. So it's a balancing act between those two things. Once you decide on your round size, it can be friends and family that fill out the round, or investors, or whomever. And I would say pursue all of them. And if it's friends and family, that's great. And if not, that's great too. It doesn't really matter. I think it's only relevant in that when you start to get into a $3, $4, $5 million round size, you're probably not going to be filling that out with just friends and family, although it depends on your friends and family. So I would say work backwards from where do we want to get to prove out value, and what round size is going to get us there, and then target the people that make investments kind of within that round size. And that way you're going to minimize dilution.
I think one of the things that I'm really finding from everything you said, and I apologize, Ian, I just to say, is this is not an easy process. This is not, raising money in general is not an easy process, and you have to figure out what is right for you at the right time and what the mechanisms are. It's complex. So, Ian, sorry.
Yeah, that was most of what I was going to say. And I think if it's possible for you to find an anchor investor in the way that Ari, it sounds like you had Shop and Penn, it really will make your life much easier, because you really just negotiate with that one party and you set the market, and anyone else who wants to be involved kind of has to come along with those terms or not. Rather than if you have a lot of people that are all of an equivalent size, they're all going to be jostling for their points, and then you agree with one, but then the next person has 1 point, you got to go back to everybody again. That could be a very challenging and frustrating merry-go-round. So even just having one anchor, and it doesn't have to be 50% of the round, but at least a significant amount more than everybody else, will herd the sheep, or the cats, really, depending on what kind of amounts you're working with.
Great. So we're going to wrap up in just a couple minutes here. In the chat, Natasha is going to put in the survey that people will be filling out. You'll also get this as you leave the meeting. So please do let us know for our audience, whether this was helpful, what you'd like us to do in the future. This webinar right here came together because of a suggestion from one of our attendees. And we were really happy to bring together such a terrific group of people around this particular topic. As we said, it's a complex one. Ian, I'm going to ask you a question next, and I'm going to ask all of you for just kind of some final thoughts. Ian, what are some of the pitfalls people should avoid when raising this friends and family round as far as structure? Is there anything that people particularly should be wary or aware of?
Keep it simple. Whatever you end up doing, whether whichever vehicle you use one vehicle. Do not simultaneously try. I mean, maybe the grant is a little bit different because that's non-dilutive money, but don't simultaneously be involved in a SAFE, a note round, and an equity financing. If you have a form of invention assignment agreement, unless there's some extraordinary circumstance, stick to your form. Right? There's going to be enough things that are going to be in the air and challenges along the way, just in the legal and tax arena for actually running your business. To keep things as simple as possible will minimize the complexity and allow you to focus where your efforts should be.
Terrific, great. And Jerry, Tom, and Ari, I'm going to ask you each, what is your one biggest piece of advice for people with regards to friends and family round? And Ari, let's start with you.
I would say, I'm a first-time entrepreneur, and I remember before we had closed on the round, I thought that when we raise this money, all my problems and headaches will go away. And, the clouds will part, and then we'll be able to do everything we want to do. And the reality is, it's just a step along a path with many steps. And like I mentioned earlier, with the money comes new headaches and new privileges, both. and new responsibilities most of all. So, you know, I think there's a kind of double edge to that. I would say don't build it up so much that it seems like this insurmountable thing, but at the same time, don't build it up in your mind so that you come to think it will be a panacea that solves all of your problems and your job will be easy afterwards. It's neither impossible nor is it a cure-all. It's just one step along kind of a long path.
Great advice. Jerry?
I think I would kind of say, like, plan, talk to people, network. Like, it's you know, it's not a thing you want to fly by the seat of your pants on. You don't want to, you know, try to, if you can talk to people, a lot of people that have been through this or consult in this space are happy to talk, happy to have some initial conversations, and get an idea of what you want to do, what makes sense for you. You know, I think that would be, you know, the area that I would suggest for individuals to do.
Great, thanks. Tom?
Yeah, those are all great points, and I echo all of that. The only other thing I would add is not every path looks the same. I think we've said some of that, and you're going to adjust on the fly. And I kind of harken back to like high school chemistry, where you know, you look at your neighbor's beaker and the solution is supposed to turn red and yours is blue or something like that, and you're freaking out. But there's not just one magic, you know, description of how that works. If you undersubscribe, there's probably a path with those amount of funds. As Ari said in the past, you know, there could be an intermediate value inflection point where you can recreate your story. So there's different ways to move. You know, I think a lot of people who've worked in the early stage or venture space, you know, pivot is used very often. And you're going to be doing that because you're creating something from a very, you know, nascent idea from a kernel. So don't be shocked by that. You know, plan, but you know, you're gonna improvise along the way.
All terrific points. So thank you so much, Ari, Tom, Jerry, and Ian, for your shared time, expertise today. We want to thank our audience for their questions as well. We love getting in all these questions and attending our webinar. We will be posting this, as we mentioned, so look for it there. And in the meantime, we hope everyone stays safe, stays healthy, and we hope we see you on another webinar soon. Thank you again, everyone.
Thank you.
Thanks.